Hello everyone, this is Debbie. I am back again to review a chapter. This chapter is going to be focused on receivables and revenue. It is important to note that receivables and revenue go hand in hand, and most likely you'll have to understand what creates a receivable and how it relates to revenue generation and then the proper recording of such transactions. In this chapter we have, as always, learning objectives, and it's important to read these because when you're reading a chapter, you really want to know what it is for you to get out of it, what you need to get out of it, what you need to be able to do and accomplish when you're done. And that's one of the things that I like to share whenever I'm doing a video presentation like this, is to make certain that you understand exactly what this chapter is intending to teach you. You want to understand how GAAP is used for proper revenue recognition. You want to be able to account for sales, also returns and allowances. What is a sales discount and how do you account for that on your financial statements? What's the recording of it, quite frankly? And then how you account for receivables, accounts receivables particularly. We're going to talk about the allowance method, and again, the allowance method is going to be an important concept, and we'll talk about the why of it when we dig into that particular learning objective. Also, we're going to talk about very, very important receivables, and these are often can be long-term and short-term receivables, notes, and interest. And then we're going to use some liquidity ratios to just discuss what they mean and how they are used to evaluate an organization's ability to pay its short-term and long-term debt. So, proper recognition. We want to make certain it's clear. One, we want to recognize revenue. Recognition means to record. It's very important. When you see recognition, you're recording something. You're recording it when your goods are delivered or services are performed. The earnings process is complete. Very, very important for revenue recognition. So, now, you're going to record the cash received or the fair market value of the assets you receive in exchange. That's all technical stuff, and generally what's going to happen is the value of the assets you're going to receive is going to be corresponding to the revenue that you generated. That's simple. In this course, you're not going to get into anything more complicated than that, but understand that's the basics and the foundation which we'll be laying everything when we record transactions. So, the kind of things you need to think about when do I record this transaction? And if I do record it, when do I record the transaction? And how much do I record the transaction? These are some things you can think about. If it's a contract, you need to identify the contract, the obligation to perform. What are you going to be performing? What are you going to give that individual in exchange for the services or the product that you're generating? What's going to be exchanged in this process? The price. And again, real world application, there's nothing going to go on without you knowing how much it's going to cost the individual and how much you're going to receive in return. That's going to be very, very obvious and very, very clear. In allocating the price to the performance obligations, again, we can look at some transactions and some examples to apply this, but it basically is letting you know that how much you record is going to be in proportion to how much of the obligation or the service that you provided, how much have you done of that particular obligation that you have to that organization. So we're going to be allocating that. So if you have a $10,000 contract with this vendor, with this customer, and the customer says, well, I want you to have this delivered to me in increments of 1/3, 1/3, 1/3. When you complete 1/3 of the work, you should recognize 1/3 of that, and so forth and so on. That's basically what this is saying. Recognize revenue when the obligation to perform something or to give something has been satisfied, and that's true. So it's really those kinds of questions and those kind of thought processes that you'll have to think about when you're deciding on whether or not a transaction should be recorded and how much of that transaction should be recorded and what period of time you record the transaction. Here we have an example. So you have an organization. They're going to deliver some iPhones to AT&T in Florida. Truck has 30,000 phones, and which AT&T is purchasing them for $100 on account, meaning AT&T is not going to give them cash at the time of this sale. They're going to pay for it with an extension of an IOU, in this case a receivable. So on Apple's side, again, each Apple phone costs $60 to produce. So we're going to be recording this from the perspective of the seller. And it's kind of important too, because when you think about these little transactions, really have to read through it. And I'm going through pretty quickly, but I don't suggest you do that. I suggest you take the time and really fully read through the question or the scenario and understand whose side of the transaction you're going to be recording. And it is very interesting to see this. It can very well be different from what I'm showing you here. If I had to say, okay, I'm buying this from Apple on account, but what if I'm going to do it from the buyer's perspective? But since we're talking about revenue, we're going to talk about it from the seller's perspective. Nevertheless, we're going to record the transaction in two pieces. One is going to establish the revenue. We're going to record the recognition of revenue earned. The second step is going to be recording the cost. How much did it cost you as an Apple organization to manufacture and this product? And you have to remove the actual inventory from your records. Why? Because the earnings process has been complete. Asset no longer is in your possession. You do not no longer have that asset. You thus have to remove it. So our first entry is going to be a debit to accounts receivable, because we are going to be debiting this because we're expecting a future benefit asset for this sale. So accounts receivable is going to be debited of $3 million. Again, it's just a multiplication of $100 times the 30,000 phones. Simple mathematics. Nothing major with mathematics here. And that's one of the things I want to make very, very clear. The math in this course is so very, very simple and intuitive. You can use your calculator to do it. The most important thing you get is not the math. It's the concept. It's the why we do what we do. It's the how we do what we do. And it's the practice along those lines. So the second entry is going to be the removing of the assets from the books. In this case, inventory. iPhones are inventory to Apple. It's there's the mechanism by which they generate revenues. Hands over fist. Most of their revenue is going to be from the products that they actually deliver. Not very much with the service, but more products. That means the iPhone, that means the computers, that means the peripherals, that means the chargers, and all of those types of things. And that's going to be their inventory. So we're going to reduce our inventory, and we reduce assets with credits. So you'll see a $1.8 million credit. Why is it $1.8 million? Because it cost them, according to this, $60 to produce. So if we're going to take $60 and multiply it by the 30,000 phones that we actually sold, that's how much the cost is going to be. So our cost of goods sold, which is again going to be shown on the income statement, is $1.8 million, and we're going to debit that and credit our inventory. So one of the things you want to make certain that you understand too is when does the asset, in this case the iPhone, exchange hands from the seller side to the buyer side, and these shipping terms will help you with that. Again, when the product is absolutely no longer your responsibility as a seller, you really truly have to record the movement of that asset and the recognition of revenue earned. So knowing these terms are going to be important. So when AT&T actually pays the bill, and it says here when it fulfills its obligation, basically it's writing a check, and it's going to pay Apple for the actual goods that they receive. They are going to show on their books, oh, we got money. I received $3 million. And we talked about recording transactions and understanding what gets debited and why, and what gets credited and why. When an asset is received by you, you are going to increase what's in your bank account. And assets are always going to be a debit to increase them. Assets are going to be reduced or removed from your books with credits. So we are doing one thing. We're removing an asset and we're actually increasing an asset. So we're debiting our cash of $3 million, and we no longer have an expectation of a benefit cash because we've got it. So we're going to remove our asset of accounts receivable with the credit. And it doesn't take long for you to kind of see what's happening here. If you can think about assets are increased with debits and decreased with credits, liabilities are increased with credits and decreased with debits, you can kind of understand the proper way to record entries when you see them presented to you. So organizations definitely want to make certain that they have provided incentive. I mean, you're going to extend credit to your customers, and that's not a problem. It really does make a difference when you do that. But you want to make certain that you can give them some incentive to pay quicker than the 30 days, and sales discounts, and also credits along those lines really are very helpful. Sales discounts for early payment, charge interest after a certain period of time, meaning if they pay after 30 days, you're going to charge them a little bit of interest. Also you can also have really good sound collection procedures. And in addition to that, tracking and doing your accounts receivable turnover and your days collected is a very important ratio, because it can tell you how effective and how efficient you are in collecting on your receivables. Very important ratios. Anyway, let's do another one, another transaction. It says Suppose Apple sells a computer and peripheral devices for $5,000 at one of its stores, and the customer pays with Visa card. Visa fee is 2%. And this is a very, very important concept to get. You're actually talking about Walmart, for example. Walmart and Apple sell goods. Apple happens to be a manufacturer of goods. Nevertheless, it does sell goods. And what happens is not everybody pays with a check. Not everybody pays with cash. Some people pay with their debit card. And how do you deal with that? And one of the things here is just giving you an idea of the real world application of understanding what's happening when you have to share part of your money that you're going to be getting. If you're going to offer the convenience of a debit or a credit card, you're going to have to pay the price of that. And that price is going to be a discount or a credit card expense. And again, here we are. Apple does not receive the full $5,000. It's going to receive the $5,000 less the fee that Visa charges them. And then in this case, it's going to be $4,900 is going to be received. So they're going to increase their cash, and they're going to record a revenue of $5,000, and that difference is going to be the discount. So here we are. Now we're talking about debit cards, etc. The major thing I would say here is understanding when you are going to expect to have to pay a fee for the convenience of offering credit cards, you have to make certain that you charge that expense in the proper period. It's very important. All of this is talking about revenue recognition, and it's also implying the matching principle. You want to match that expense to the proper period that you generate the revenue. And here is a classic example of you matching the revenue with its appropriate expense. How do we deal with sales returns and allowances? And again, if you're talking about products, this is specifically to products like an Apple iPhone or Apple computer or an iPad or some other product, maybe merchandising, etc. They also provide you the opportunity to turn it back in. If there's something wrong with it or you're not satisfied, you can return it. How do we record these transactions on our books? So if we assume then that an organization has to record their net realizable value of their accounts receivable, meaning this is exactly how much we're going to get back, we believe, considering the possibility of someone returning their goods. So in this case, we're saying that based on their experience, they have 1% of their sale items eventually gets returned for whatever reason. So they want to record the transaction, but they want to also estimate the possibility of these returns and adjust inventories. And here we have an entry to do that. And this is appropriate GAAP accounting. We definitely know that we have of sales that we're going to be generating, but there is always that possibility, a real possibility that we're going to have returns, and it would be misleading to individuals looking at our financial statements if we don't disclose that, and we do that through our allowances. So in this case here, we're going to estimate that if the organization's revenue is for June is $200 million, and we're going to assume or estimate that possibly a good amount of that's going to come, well, not a good amount, but some of that might come back in terms of returns. We want to show that in an allowance account. So we're going to record the two entries at June, assuming that cost of goods sold is 60% of sales. So first of all, we want to show our allowance, which is going to be sales return and allowance. This account is a contra revenue account. Very, very important. It is going to be a offsetting account to the revenue. So it's very important to know exactly where these accounts lie on the financial statements. So we've got a 1% of $200 million, which is $2 million, and we're going to debit that. And then we're going to show a sales refunds payable. And again, that could be a cash payable or refunding their debit cards. But until the refunds come through and are realized, it's going to sit in a payable account, some liability sitting there waiting to pay back those individuals who decide to return the product. The second entry is going to be the same, but it's going to be based on the fact that we're going to reverse the cost of goods sold for the portion of the sales that we believe are going to be returned, or the product that we believe are going to be returned. So we're going to be reducing our cost of goods sold and putting the money back into our inventory. But we're going to put it into a inventory returns account. Why do we do that? I think it's very, very important to show clearly on the financial statements the returns separate from the inventory itself. It's most certainly full disclosure, and it makes it very easy for people to understand the nature of what's truly inventory and what we expect of our inventory that will be returned. So setting up an allowance account is very, very important, and I believe critical for historical purposes, and also for the point of this being very transparent, so that others can see exactly what our inventory is and what we expect to be returned. So here's the entry just saying this is how much they actually returned, versus in the previous slide we basically said 2 million would be returned. See the difference? So we need to record the actual refund that we provided to those customers, which is in this case cash of 1.8 million, and then we're going to reduce the obligation, which is the sales refunds payable. We're also going to adjust the inventory that was actually returned, and if you can see, inventory actually gets debited, because we're going to bring back those items because they actually came back to us, and we're going to reduce or eliminate partially the estimated inventory returns. How do we account for discounts? Again, when we have our customers and we want them to pay on credit because it encourages more sales, we want to give them some incentive to pay quicker than the normal 30 days or the normal 15 days, whatever the terms are for that particular company. To do that, we say, we'll give you a 2% discount if you pay in 10 days. Or in this case, you'll pay the net of that sale in 30 days. So that's important. Not all organizations take advantage of that, but it's most certainly, for many companies, like to have the opportunity to save a little bit of money. And 2% discount is most certainly a great incentive, particularly if it gives you 10 days in order to make that decision. How do we record it, by the way? Well, I'm going to use an example, and we're going to talk about Ace Hardware, and everybody heard of Ace Hardware. They make sales of building materials and other large construction companies. They encourage their customers to pay within 10 days, which is a very, very quick turnaround, and it's great for Ace's cash flow. So they offer their customers 210 net 30, 2% if paid in 10 days, net if paid in 30 days. So June 30th, they sell 100,000 of lumber. They sell it on account to Sorrell's construction company, and the lumber is delivered that day. Very important, because the moment it's exchanged hands, you know when you have to record the transaction. The cost of the lumber to Ace is $75,000. So let's take the entries and do them separately. The first thing we want to do is record the sale itself. And you'll notice here that we're not dealing at all with the sale on the 2% discount, because we're debiting our accounts receivable of 100,000 and we're crediting sales. Where's the 2% coming in? Well, we'll see in a minute. The second entry is going to remove the asset from our books. Obviously, it cost of goods sold. It's going to be the cost of how much it cost us to manufacture or to provide this service. So we're going to debit that for $75,000 and reduce our inventory. Now, here we are. Now that they've decided to pay it in full, but let's take out the date. We got a June 30th date here that the purchase was made, and then 10 days later, because July 10th is exactly 10 days after the date of sale. So now we know they are in fact entitled to that refund. So on July 10th, our entry is going to be an increase of cash of 98% of that 100,000. That's essentially 2% minus the 100%. So the 100,000 is going to be reducing our accounts receivable, and the difference is the discount. And notice that the sales discount account is a contra revenue account, and you will see this number on the income statement. And here is just Apple's net revenue. Most companies will say our gross sales and our then they will say sales returns and allowances, and then they will come down to a net number. But here we just see it on one line. So far it's starting to really come together how we are recording these transactions, why we record them the way we do, and then various scenarios on examples of these particular concepts. Not a very complicated concept to learn, but it's very important that we practice these over and over again in our homework and problem sets, simply because these concepts need to be reinforced and practiced, and that's really most important with accounting. So how do we deal with receivables? Well, for one thing, what is a receivable? And and this is an example. Example is going to be some kind of claim against somebody else. You have access, or you have an expectation of some kind of asset or benefit from somebody else as a result of what you've done already for them. It is current, which means it's due to you within 60 days, but most often due within 1 year. It's going to be a current asset on your books. Trade receivables are definitely going to be your ongoing with yourself and your clients, customer to customer to customer. Your receivables is not necessarily a note. Why? Because they're generally going to be non-interest bearing, and two, they're also going to be not associated with any kind of document, a legal document or written. These are trade receivables are generally going to be kind of like you getting a revolving line of credit without any security, essentially. So they're required by selling goods and services, or basically lending money. And generally this is going to be the entries that you're going to record. Some differences, but you can rely that these are going to be very close to the type of entries you're going to be recording. So here we have the general ledger overview, which gives you your balances for all of your accounts, specifically here accounts receivable. But your subsidiary ledger is going to have all the details, and all of those details have to agree to the total that you have in your accounts receivable account. Very important concept to see that. So how do we manage them? We want to make certain that we run credit checks. We make certain that the people that we want to do business with have the ability to pay us back. We want to make certain that we do the adequate controls to make certain that the individual can pay back, that they are legitimate, that you have definitely a policy in place to ensure that you check every single customer and ensure that you can get your money back. Monitor your payments, your customer payment habits. Obviously, have your cash handling and your record keeping responsibilities separated. And we talked about that in the previous chapter. And also deal with sending out statements, second and third statements, making phone calls when an organization hasn't paid their bills, and giving also an opportunity for organizations to have their payments to you electronically sent to you through an EFT. That's a very good way to ensure that you get your money quickly. So within a GAAP accounting, we want to make certain that when we show our receivables on our books, we show what we can reasonably assume will come back to us. This brings in our collectibility allowances for our accounts. We want to make certain that we want to record our receivables in 100% that we're going to receive. But as accountants, we have to think about there is a possibility that one or two or more could very well go bad. And if that possibility exists, and it does, we have a duty to estimate what our collectibility or our uncollectibility will be. So we can buy on credit and our profits go up because we allow more people to purchase without having to pay cash immediately. But it's going to cost us because we're going to have to, sometimes people, they do default and we have to pay for that. And so we have to make certain that we deal with the reality that if there's a possibility that someone's not going to pay, we got to make sure our accounting records reflect that. So we do that using the allowance method. The allowance method is a way to calculate what we think are possible uncollectible accounts. And it is a contra account. And this is how it is shown on the financial statements. Regardless of how we calculate that number, this is a good presentation of how the receivables will look on your financial statements. It is definitely there to offset the receivable, and never put in a net number with the accounts receivable. It's always going to be a separate account, and we want full disclosure. So here we are. How do we do it? We have a number of ways of doing it. The book can call it the balance sheet method or the income statement method. Either way, both work, and neither one are better than the other. It's all a matter of the organization's practices and what works best for them. So now going back, the income statement approach, it again is just going to collect what do you believe is going to be the uncollectible amount, percentage of revenue basically, and record a transaction. Or the balance sheet approach is going to be analyzing the outstanding balances and determining what the allowance is right now and recording the difference. And we'll talk about that. So percentage of sales method says, okay, we have $15,000, $807 in receivables. and we have a credit balance in our uncollectible of $5. Okay. That being said, let's assume then that we have a credit department is estimated at 0.002%, a fraction of a percent is going to be of revenues might be uncollectible. So we're going to take our revenue number and multiply by this factor, and that's going to be our uncollectible expense. Very, very straightforward transaction. Debit our uncollectible account expense, bad debt expense, another term, for $43, and then we're going to credit our contra account for allowance for uncollectible accounts. Percentage of sales method is a little different, and it's not harder, just different. So let's assume with this information we have our accounts receivable of $15,000 and we have our ending balance of $5, which we have already. Now, if we're going to have an uncollectible expense, if we're going to say our uncollectible expense is going to be $43, we're going to make sure that our ending balance is going to be the net of the two. And that's a really good way to see how it works in a T account format. So the main point I would like to show here is we are trying to find out how can we calculate that reasonably estimates what our uncollectible experience will be. This is not an absolute, it's most certainly a guess, and most organizations have to reevaluate that guess at the end of every year to ensure that it is actually reflecting their experience. So don't get so caught up in the different method. Just understand that these are just tools that allow organizations to compute to the extent that they can what they think will not be paid back to them from their customers. And that's as simple as that. So here we want to take and age all of our accounts. Basically, and it's very, very simple computation. It's a multiplying the number of days, the percentage based on the number of days that those items are outstanding. That means that the longer the item is outstanding, the higher the rate of uncollectibility. Logic says if you have an outstanding that's owed 90 days, you have a very high probability that you won't get your money back, which denotes the reason why the numbers increasingly get bigger. So the aging method is going to bring the allowance account to where it needs to be. Once you do that, then you record the difference, and that's going to be your adjustment. That's why it's a little bit more work when you're doing it the balance sheet method versus doing the income statement method. But in the end, we all get the same conclusion, and that is we are going to record what we believe are accounts that we might default, and we're showing on our financial statements the net realizable value of our accounts receivable. We believe we most certainly have claims to receive in cash, and that's most important. So writing off your uncollectible accounts, again, we're using the allowance method because it's a GAAP approval method. So we've already recorded our bad debt expense, and we already recorded our allowance. So what happens when they actually do default? What do you do? What entry you record? Well, you want to make certain that you remove the receivable off your books and adjust down your allowance. And that's what this entry essentially is doing. We are removing the receivable off the books with a credit, and we are also reducing our uncollectible account allowance. That's the write-off. Now, again, another picture of how it looks in T account format, but the most important thing is what we're doing and why we're doing it. And the method that we use is all a matter of just you practicing and the concepts, practicing the percentage of sales method, how it's computed, how it's recording, and then also the approach of the aging of receivables, how it is recorded, how it's computed. And then again, the direct write-off method is not approved by GAAP. It is approved by the IRS. So this is going to be the income tax method. You cannot write off your assets basically when they default, when you know for a fact you're never going to get the money. That is not an acceptable way to do it for GAAP purposes, but it's the only acceptable way for internal revenue purposes. So it's important to note, when you know that the asset is never going to come back to you, the organization has filed bankruptcy, that debt is dead, you write it off at that point. And you do that by saying, I'm going to remove my receivable, which is a credit, and record a bad debt expense with a debit. And here is the entry. And it's called uncollectible account expense. It's also used terms like bad debt expense. In the end, it's the exact same thing, just different wording, but the same thing. Now, again, if your customer decides to pay you back, the most important thing I would say for you to understand is you have to first reverse the debt that you wrote off. And then once you reverse the debt you wrote off, then you can actually record the payment you received from your customer, if that customer decides to make good a debt that that you have previously written off. So how do we account for receivables? Again, the note receivable is going to be something that has to do with borrowing of money. It has to do with a principal. It has to do with interest being charged to it. It has a maturity date, and it also has some characteristics of being something in writing, because you're talking about a note. So that makes it a little different. It's different from accounts receivable because it's not a trade. Number two is borrowing of money most often, and it's tied to an interest rate, and most certainly it's a term associated with it. A short term, which is within 1 year, or long term, which is a 2 year or a year or longer. So a promissory note here is, again, a written document saying that you promise to pay someone a certain amount of money using a level of interest that's noted on the face of that document, in this case 9%. And here we are recording the promissory note. And again, a note receivable, again, is an asset to you, and you have here a reduction of cash. And then here is the recording of the interest, and it's simple interest. The principal times the rate times the time. And you see here 4/12 of the year means that's only 1/4 possibly of the year, or 3 months. And then here is the transaction. Here's a note. And never ever, this is one thing I want to say before I even close out, never lump the interest with the actual note. They must be shown separately on the financial statements. So note receivable is going to be one account, and the interest associated with that note is going to be a very different account, and they most certainly must be disclosed on your financial statements. And here we go. And this is just showing what happens when the money is actually received by that organization. Now again, here just giving you some ideas of how to calculate interest, because we're talking about principal multiplied by the interest rate multiplied times time. And here is just giving you some of that. Now, as I conclude, I want to make certain it's very clear. Ratios are very important tools to use to assess the ability of an organization to either pay its debts, or their ratio of return on the profit or earnings, or some other type of ratios. They're not end all. They are just guides that you can use to indicate the organization's ability to pay back its debt. In this case, the liquidity, the level of liquidity of that organization, how fast they get their money back, how quickly they are actually able to turn over, get their money from their receivables. And so it's very, very important. Again, you don't want to rely on them to be the end all, because looking at the industry and comparing your ratios gives you a better idea of how well the organization is doing in light of their other counterparts within the industry. And accounts receivable is important too, because how long does it take, for you to turn your receivables over? What do you mean by turning them over? Well, when you set up a receivable for your customer, and when they pay it back, that's when it's turned over. So that's really giving you an idea. You're turning over your receivables. You're getting your money back. You're establishing a receivable, and you're immediately turning that over in terms of cash. And the quicker and the more often that you do it, the more efficient you are, and the better financial position, particularly if it relates to liquidity, that organization is. Days outstanding is very important. Days outstanding is going to tell you how many days did it take on average for you to get your money back from your receivables. And if it's under 30 days and you have a 30-day credit terms for your clients, that's very good. But if it's 35 days and you have a 30-day credit terms for your creditors, that's not good. So in light of your policy and what really gives you an idea whether or not these days numbers that you're calculating is a good number or a number you should be concerned with. Again, I really appreciate the opportunity to talk with you about this chapter. I think there's so much that you can learn. And again, my suggestion would be always practice and never stop practicing your accounting. I'll talk to you again soon. Bye-bye.